The S&P 500 index is a highly followed, broad-based market index. But for some people, there's an ETF that is better than the S&P 500. If you are retired or working toward retirement and trying to maximize the income you generate, you may want to consider the Schwab U.S. Dividend Equity ETF SCHD. The S&P 500 is great if you want to track the market, but what if your goals are a little different? For example, what if you need income? Well, investing isn't a one-size-fits-all situation, which is why there are so many different investment approaches you can follow. And yet the common reference point for most investors is the S&P 500 index. Here's one big problem for a retired investor in need of income who simply defaults to the S&P 500. The S&P 500 index dividend yield is a scant 1.3% today. It would be hard for a dividend investor to live off of that, which is why a better option just may be the Schwab U.S. Dividend Equity ETF, SCHD, which has a dividend yield of nearly 3.5%. There's nothing wrong with the S&P 500 index. In fact, as far as indexes go, the S&P 500 index is fairly well constructed. For starters, it owns a large number of stocks, providing plenty of diversification. The stocks are selected based on their size and importance to the U.S. economy, so they are notable companies, not obscure businesses. The stocks in the index are weighted based on market cap, so the largest stocks have the most influence on the index's performance. That's pretty representative of the real world, and it ensures that anyone who owns the index is putting more money into the best-performing stocks, which are usually, though not always, the largest ones. But just because an index is well constructed doesn't mean it is the right index for every investor to own. As noted, the yield on the S&P 500 index is a slim 1.3%. That's a very small number, and it would require a huge investment to generate a meaningful level of dividend income if you just owned an S&P 500 tracking ETF like SPY or Vanguard's VOO. A better bet would be to buy an ETF focused on generating dividend income. A good option is the Schwab U.S. Dividend Equity ETF, SCHD, which offers a yield that's nearly 3 times the size you'd collect from an S&P 500 ETF. But before you buy the Schwab U.S. Dividend Equity ETF, or any ETF for that matter, you need to dig into the investment methodology. In this case, the SCHD is trying to create a balance between quality and dividend yield. That's notably different from an ETF like the Spider Portfolio S and P500 High Dividend ETF, SPYD, which simply buys the 80 highest-yielding stocks in the S&P 500 index. To get its final list of about 100 stocks, SCHD first removes real estate investment trusts, or REITs. It then screens for companies that have increased their dividends annually for 10 consecutive years. This creates the base list of investment candidates. For each of these potential investments, it creates a composite score using cash flow to total debt, return on equity, dividend yield, and the 5-year dividend growth rate. The scores for each company are ranked from best to worst, and the top 100 are the ones that get into SCHD. Let's look closer at SCHD. First, the expense ratio is a low 0.06%, meaning on a $10,000 investment, you'll only pay $6 annually in expenses. Now check out the 1-year, 5-year, 10-year, and max growth rates. Looking at SCHD's dividend payouts, we see that Seeking Alpha grades it as an A+. Look at the 3-year, 5-year, and 10-year compound annual growth rates. You can also see that SCHD has 12 consecutive years of dividend growth, along with an annual payout of $2.67 per share paid quarterly. The latest payout was 61 cents per share. The end result isn't an income-focused ETF per se, but an ETF that tries to ensure that investors own good companies with growing businesses and attractive yields. All in all, based on the investment approach, SCHD sounds like it would be a pretty good option for most dividend investors who want a simple way to invest in dividend stocks. Pair that with a broad-based bond fund, perhaps like Vanguard Total Bond Market Index ETF, BND, and you'd have a fairly solid foundation for a balanced portfolio. Notably, the Vanguard Total Bond Market Index ETF, BND, has a yield that's a bit over 3.3%, and you could probably do better than that if you were willing to take on more fixed income risk. The S&P 500 index is great, but it isn't the right investment option for every investor. For example, the S&P's goal is just to represent the broader economy, which is not going to serve dividend investors very well. If you are looking for income, an ETF like SCHD will probably be a better choice. It is specifically designed to meet the needs of dividend investors looking to own high-quality growing businesses that pay attractive dividends. Please note that I am not a certified financial planner, and the content shared in this video is for informational and entertainment purposes only, not financial advice. Always do your own research before you buy any individual stock or ETF. SCHD may prove to be a very nice addition to your investment portfolio. Thank you for watching. We hope you enjoyed our content. If you did, please leave a like, share with your friends, and subscribe for more updates. And don't forget to hit the bell icon to get notifications for our latest videos. We appreciate your support and feedback, and we're always excited to bring you new and engaging content. Until next time, stay curious, keep exploring, and we'll see you in the next video.